Okay. Good afternoon, everyone. My name is Michael Nassif. I'm Vice President of Property and Casualty for USI Insurance Services. And today I'm here to talk to you about captives and why they're increasingly a great solution for middle market and lower middle market companies in 2025 and beyond. So today's agenda, I'll be speaking a little bit about myself and what makes me qualified to speak on the matter, and then diving into the topic of today's conversation, which is captives for middle market companies, followed by some Q&A. A little bit about myself. My name is Michael Nassif. The name is Lebanese, so it throws a lot of people off. It is a result of my grandfather going to Mexico and marrying my grandmother, who's Mexican, and having my dad, who's half Mexican, half Lebanese. And my mom is from El Salvador. So my parents are both immigrants. They came here as young adults. My mom fled her home country when it broke out into civil war in the 80s, and my dad came to find opportunity that he couldn't find in his native Mexico. So not only have they been married for 40 plus years, they've actually had a business relationship for 40 plus years, and they have an immigration law practice that they're still practicing to this day. And they did quite well because they sent me to a private school called Delphi Academy of Los Angeles, and I graduated from there and went on to attend CSUN and got a degree in economics. I have a diverse background which encompasses law, entrepreneurship, and insurance. And I started off working for my dad out of school, and thought I would go into the family business. But before settling in, I really wanted to try other things, and I had an itch to just see what else was out there in the business world. So I saw some friends do really well in insurance, so I figured, hey, what the hell? It's only like a 1 month long process to get the license, and I got licensed and started working right down the street from here in West Hollywood. I started off at a small brokerage and did quite well, to my surprise. I never thought I would actually be doing what I was doing at that time, but it was a good learning experience. After a couple years of that, I decided to scratch another itch, which was entrepreneurship, and started a catering company with a high school friend of mine and another business partner. And that was amazing. It was really fun. It was a great experience. It taught me a lot about what it means to be a business owner. Very hard work, and I ended up exiting that and going back to insurance, but this time with a new perspective. And that of a business owner, and what small business owners needed to really cover themselves properly, and so that was a 7-year journey that resulted in getting recruited by USI and going to their middle market department. So and another thing is that since my dad is a lawyer, and I always kind of wanted to do this, so at some point I decided that this is my year, and I'm going to apply to law school this year. So. Wish me luck. All right. Well, a little bit about USI. We're a national firm. We do insurance, risk management, and consulting. We have offices all over the United States, primarily here in California. We have several in the Southland, and I'm out of the Woodland Hills office.
Where are you in the rankings by size?
So by size, if you check out Insurance Journal, which is a trade publication, we're usually around like 5 or 6 in America.
Am I right? Did Goldman Sachs private equity buy?
No, KKR.
KKR.
Owns USI.
Yeah.
I like to joke and say that I was USI's DEI hire, which is, I'm not.
That was last year.
So it's been a wild ride. I've been there a year, and I've learned a lot, especially what it really means to provide insurance and risk management services for middle market companies. One of the things that I have learned is about captives, and that's the topic of today's conversation. So captives are, like I said in the beginning, they're an increasingly a great option for middle market and lower middle market companies, because they weren't always available for middle market and lower middle market companies. They were once reserved for the really big corporations, paying millions upon millions of dollars in premiums, and now they're more and more accessible to smaller, well, middle market and lower middle market companies. This is a trend that's been going on for years. Because the captive market has matured a lot, there's a lot more competition, and that's making the players in the space lower the minimum requirements. So nowadays,
How are you defining the lower middle market for this? What's the range then in revenue?
so middle market is between 20 to 200 million. Anything below 20, I would say, is lower middle market. So like between 5 and 10.
Okay, fine.
All right, and but thank you for the question. So what's a captive? Anybody heard of a captive in here? Anybody? Yes. Okay, quite a few of you. Great. So it is in essence a company that is set up to provide insurance for its parent company, and there's different ways to set that up. But in essence, the parent company becomes the owner of an insurance company, and as an owner, you get a lot more say in what you can cover, what you can do, how you can write things off. You get the picture. You're the owner. You get to call the shots. To certain degrees. Obviously, it's a regulated space. So, but it does come with its advantages. So, just to do a little recap or a brief explanation of what a captive is. There's the pure captive, which is just a single company that creates a captive entity to insure itself. It's one company, and it owns its captive, and it's exclusive to that company. That's a pure captive. Again, that typically is seen with very large companies. Middle market companies, now they have the option to join group captives, which is, again, something that is a trend for many years now, and has become increasingly more popular. So a group captive is a group of companies that they could be of the same industry vertical, they could be different verticals, but they're pooled together to share resources and distribute the risk. And then finally, there's cell captives, which are even smaller companies that form a larger company, a larger group. And the way you can kind of picture the difference between those two, group and cell. Group is like a big house where everybody's a roommate, but the decisions of one roommate could affect the other roommates in the house. Cell is a little bit more like an apartment building. Everybody's under the same main roof, but it's a little segregated, and the decisions of one doesn't necessarily affect the other.
Who's the sponsoring, organizing entity for these groups and cells?
Great question, and I'll get to that
We'll get to
in a
that.
moment. So, why would a company decide to do this? What problems do captives solve? What are the advantages? Well, as I mentioned earlier, you're forming a company, right? So, you get a lot more control and a lot more say in what's going to happen with your coverage, with your insurance coverage. And it's a great way to manage costs. Obviously, the main reason you would do this would be for cost savings, but there is a caveat with that. It's not a short-term cost-saving measure, it's a long-term strategic play. So it gives you more predictability of premiums. You do have to have a lot more skin in the game with captives. When you do that, you take a smaller premium, which is advantageous, but again, you have more skin in the game, you have higher self-insured retentions, which I'll get to that in a second. Potential tax benefits and favorable tax treatments. Again, you are the owner of this company, so you get to write things off. Consult your tax specialist on that. I'm not one of those. Potential investment income. So my good friend in the insurance business, you may have heard of him. His name's Warren Buffett. He bought insurance companies back in the day, and he's done quite well with those. The reason he loves insurance is the float. The float money is that reserve money that all insurance companies are required to have in order to pay out their claims. They can use a portion of that to invest in securities and earn income. And as an owner of an insurance company, you would be able to do the same. So ability to consolidate property and casualty and employee benefits under one roof. That's a big one. Employee benefits are increasingly becoming a big line item for companies, and having a place to put both of those has its advantages and economies of scale. And lastly, as I mentioned earlier, the bar for entry is being lowered and allowing more access to companies that didn't have access to this before.
I have a question.
Yes, sir.
I'm thinking back to your prior slide about group captives, and I'm thinking that there's a way to select your group and cell members to reduce risk. Is there
Absolutely.
a
So that's a great question, and there is a voting process. You can't just join one, and you have to apply to join one, and the members of it have to take a vote in order for you to be admitted into it.
I'm thinking strategically that there are certain risks that offset other risks as opposed to risks that compound other risks.
Yes, you're right about that. Yes, and in another slide I have coming up, you'll see the team that puts this together, and someone that would take that into consideration would be an actuary. So they'll sit down, crunch the numbers, and if there are companies that would not benefit from being in the same room together, they usually don't get put in the same room together. So great question. So yes, key considerations. It's not all sunshine and rainbows in captive land. You do have to take things into consideration when doing this, because after all, you are forming a new entity, and there's things to consider. The importance of due diligence. It's much easier to do your homework up front and do it right the first time than to try and unwind or back out of a captive that's costly, and nobody wants that. You do have to have an existing culture of risk management. It really, so since you're gonna have skin in the game, you don't want to run kind of willy-nilly with your operation. You really want to be safe. Make sure that the claims are under control, and not everybody is going to be able to qualify for a captive due to running a little hot on claims. So that's something that they have to consider as well, and kind of ease their way into it or be strategic and line that up. Strong financials. So you do need the ability to collateralize in the form of like a letter of credit, unless you want to post cash for your collateral, but not everybody's going to want to do that. So have to have strong financials. Upfront costs and administrative costs. Again, you are forming an entity, and there are startup costs for that. There are costs ongoing for the maintenance of this entity, and risk tolerance. You have to be willing to have the skin in the game and have a little bit more appetite for risk, but the rewards can be well worth it in the end. Everything making sense so far? Am I talking way too fast for you guys? All right, great. So other things that other problems that captives help solve. Again, as an owner of an insurance company, you have a lot more say in what you're going to cover. For example, things such as complex emerging risks, complex property, liability issues, they can all be resolved within your captive. So I'll give you an example of the great state of California. Half of it is uninsurable because it's next to a mountain, and captives are increasingly becoming a solution to put that property line of coverage, whereas the open market just doesn't have the appetite for right now. Like my friend over here was probably with a fair plan for quite some time before he was able to go back into the standard market. Insurance is constantly changing, appetites are changing, and so having a captive gives you a little bit more stability and say in what you can cover. Changes happen slowly at first and then all at once. Like California it's always been here, but it's only in the last couple of decades that it's been an issue where it's been really hard to place property coverage. And then, so captives are great solutions for these types of issues that middle market companies face. This is my favorite slide in the whole presentation because it shows you the team that it takes to put together this. It really does take a village, like this slide can show you. It takes someone in my shoes as a broker or risk consultant to help that company really get ready for a captive. Again, not everyone is ready for that. And it takes planning and strategy to do that. It takes legal counsel, takes lawyers to put together contracts and form entities, things like that. Banking and investments, again, they're because of the requirement of collateral. Banking relationships are key. Investments, that money that's going to accumulate the float that you're going to be able to invest. Need someone to help you with that. Auditors, my friend Brian over here. Actuaries to crunch the numbers and make sure that the premiums are right, and tax consultants to my friend Heath over here to help you navigate the tax landscape. So again, takes a team, takes a village to pull this off, but it can be very, very, very profitable for the company that is willing to do that. So USI, where we shine is that we have in-house technical resources that really shine a light and take the mystery out of this. The empirical analysis that we conduct will be all pre-underwriting before you ever pay for a feasibility study or anything of that nature. So it really takes the mystery out of it and really paints a picture for the owners so that they have a clear understanding and can make sound decisions based off of the empirical analysis. In summary, captives are a great option and becoming increasingly more popular in the middle market and lower middle market space, and will continue to do so for the foreseeable future because as we've seen, markets can be a little volatile. Insurance market is no different, and captives help shield that business owner from the volatility of the insurance market. So, thank you to you, everybody. That's my presentation. Any questions?
So I got two.
Sure.
First question, what's the IRS doing about these captives at this point? Because there was a lot of back and forth over the last 15 years on micro captives and not captive.
Yeah, that's a great question. Taxes are not my forte, but I will defer that to a tax specialist. What was your second question?
Yeah, second question. You mentioned like insuring your home in a captive. Are the captives attached to a business?
No, I was giving like an example, an illustrative example of
I thought
like.
that was interesting. I'd love to insure my home.
I'll pull in.
Well,
Yeah.
if I, like,
Could we
quite
form a cap?
genuinely, I'm developing 10 acres that was just under evacuation warning because of fire, so everything's
no.
California Fair Plan, so my ears also perked up.
Yes.
And like, how feasible is that without this devolving into 2 hours of conversation to like, everybody in my Malibu neighborhood creating a captive?
It like he said, it really is more of a commercial or business type of arrangement, and not something that you can get together with a bunch of homeowners. So that would be something that
Even if the corporations are the winner?
that's a well, that then in that case those corporations can form captives. Yes.
What if I own half the neighborhood?
There you go.
That's what I was trying to, like, is there a sweet spot of, if there's a certain asset value or like to make it worth it? That's what I'm curious.
Yeah, I mean, yes, the statement of values would have to, so this property schedule would have to be quite substantial. Numbers, I mean, it really depends. Again, there are many types of captives.
You're self-insuring, so basically if your property's worth $1 million or the structure, I'm just using an example, you're gonna have to be able to fund that $1 million if the house is destroyed.
Right.
So the whole idea of a captive, it's bigger, and there's, and then you buy, there's something else you buy.
Reinsurance.
Not reinsurance, there's something else, there's another kind of insurance you buy with it. Catastrophic or something.
Catastrophic.
What you mentioned it earlier, I'm sorry, you said it earlier in there. Anyway,
I can go back.
You buy another
Yeah.
policy if it's something it goes higher than what it was.
Right,
That's
and
the
it brought in
reinsurance.
someone to expand our real
That's the
estate
reinsurance.
portfolio, which is why it might have to scale.
The whole idea is you're getting a bigger
Yeah.
group of people together.
Mhm.
It's like we did a captive for our health insurance, and it worked out really well, because we were able to move the premiums each year to work, you know, because we built up a big reserve.
Yeah.
So we were able to pass it on to some of the employees, plus pass it on to ourselves.
Yeah, so along those lines, I think about the economics, and I imagine that you stand to potentially capture the profit margin that the insurance company would otherwise get, right?
It's an excellent point.
And if your employees or property or whatever are not utilizing the insurance and payouts at the same rate as you're putting in, then you accumulate assets that you get to
Absolutely.
monetize, right?
So-
But then on the flip side, if you have a bunch of employees who are like drawing down insurance payments to cover medical expenses, then you could be paying more than if you shared the cost with other people through another program, right? So like, can you talk about the economic kind of risk and benefits in
Yeah.
just order of magnitude?
Absolutely. You brought up a great point in that every dollar you pay your insurance company, they're taking 40% of that, 60% of that, setting that aside for claims, to pay out claims, whether that claim gets paid out or not, right? So at the end of the year, if let's say they used 50, there's still 10% left over, they get to keep that, right? When you own the captive, that stays within your captive. And so that does accumulate.
If they pay out 70, then they're footing that $10 cost, and then they're hitting you with higher premiums next year to start recouping that, right?
Exactly.
But you got the risk pool, you got the risk pool, Mark.
Right.
That takes care of a lot of that, so it's not all hitting the
Yeah.
owner of that one captive.
Mhm.
You get to take 1.8 million in premiums a year tax-free, and you deduct it from the business. So that's a huge part of it too.
Tax-free or deductible?
No. It's deductible.
And
on
not
the back end, it's
taxable to the
tax-free.
captive.
It's insurance.
Small insurance companies that have premiums under $1.8 million get taxed without getting taxed.
So the payout
So
is
the
tax-free.
payout is captive-
tax-free, but the premiums are deductible.
The premiums are deductible,
Right.
and then the captive that holds the money
Does
the
not
money has to be
recognize
tax-free,
income.
But you can't do that in micro or cell captive. That only happens if you have enough companies that you're insuring that are all yours and you own the captive by yourself.
That's an 83B captive. Okay.
831.
831.
Very different.
Right. 83B.
831.
83B is an election.
It's 831. There's no income to the captive for the premiums up to $1.8 million.
I thought he was talking about the owner, the
It's
owner.
regardless with CPI. Doesn't go with the CPI.
Yes, sir.
Let me ask you a question real quick, because one of my clients went into a captive, but helped him out where we need, but within 6 months of me booking the loan, I found out that he was trying to fraud me. I luckily exited the client without any loss, but curious, from your point of view as a captive, how do you vet these people out that they're not going to commit fraud? Because they duped me. I think I'm a pretty savvy banker. I've got 2 decades in, but insurance, obviously they dupe their captive as well.
That is an interesting example. Yes, I mean there's really, if there's a will, there's a way. If they want to defraud you, they're going to defraud you no matter who you are. People defraud J.P. Morgan Chase all the time. So no, what I'm saying is it's I mean, you can underwrite it, you can do strict analysis all you want, but there's always going to be those folks that cheat the
There's
system.
always, there's business risk, there's financial risk, there's also theft risk.
Yeah.
And that's one of the things you have to worry about.
Michael, does the captive need to be licensed with the state insurance?
That's a great question. So in the United States, there's 10 states that you can domicile a captive in. A lot of captives are overseas, in the Cayman Islands and other Caribbean islands and things like that. But in the United States, there's 10 domicile states.
Okay, which is why they need to be audited, because it's regulatory requirement. Okay. More questions?
From a numbers standpoint, right, so if I'm a small, medium-sized organization, the criteria for should I be thinking about a captive, is it the total amount I'm spending on insurance that's largely the driver of does a captive make sense for me, or are there other metrics that I should be thinking about?
It makes sense once you exceed like from a revenue standpoint, once you're making 3 to 5 million a year and paying like over 150, 200,000, you could really start to look at it at that point, because like I mentioned in the presentation, increasingly it's becoming more and more available to companies that are really not that big. So and that hasn't always been the case. Yes, sir.
It's gonna be for you and Bob. You had a slide up, you just touched on it about cybersecurity risk. And how would that work with a captive and?
I don't think there's that much, I mean, I think the nice part about doing that in the captive is that you can manage the type of coverage.
Exactly.
Because when I look at coverage, they say, we need $1 million, we need $5 million of cybersecurity coverage, but what are you actually covering? Are you most worried about having, like for instance, I would cut out the ransomware. I would have certain things, investigation, but I won't pay ransom, so there you go. But other parts and notification can be but there are some things that are very standard, but you could customize it, which I think is a great advantage, because then you get real money, real advantage.
Yeah,
Well,
to his point.
No, I was gonna say, but while you said you'd exclude ransomware, from a client perspective, they want ransomware in their captive, whether they're gonna pay it or not, because at the end of the day, you want to line item that risk, depending on how the captive, what you're using the captive for, right?
Yeah, I mean, part of it is just my attitude to ransom, but it's possible you could do it as a financial issue, because if you can have it but not pay it, maybe that's one way that you can goose the returns. But on the other hand, everyone says you need cybersecurity coverage. They don't say what coverage you need. It's not like other types of insurance where they're mature enough to understand what kind of risks you really face.
Great point. I mean, cyber coverage hasn't been around that long, to your point, and it is evolving and maturing. And when you own the captive, you get to say, okay, I want this covered, whereas the open market will say, no, yeah, it's excluded. You can't have that coverage. So that's has its advantages.
So a group of companies could set up their own captive just for cyber insurance, have other coverage for property and casualty, but go ahead and have a separate captive for just to cover cybersecurity?
Yes, they to answer your question, yes, they can do that. Not all coverages are suitable for captives, and some captive managers and some captive companies they will restrict the types of things that you can put in there. But you can still get those on the open market if you need those lines. Yes.
In that situation, could you, for captives, insure against litigation risk in case something goes wrong with it, or in case just captive goes challenged?
That is a great question. There are again certain covers that you cannot buy on the open market that you can write yourself in the captive, and that would be one of them. Yes.
Can you describe the reinsurance, how that works?
Yeah. So with the captive, there's a couple of funds, and this is going to get a little in the weeds, but there's an A fund which pays for frequency claims. A B fund that pays for severity claims. So in this band, you're going to be paying out a lot of these claims yourself because they're going to be small, but they're going to be frequent. And when you exhaust that, you're going to tap into this one because it's more of a severe claim, and then anything above that is covered by reinsurance.
So it's just kind of like a high deductible medical insurance plan for an individual or a family, right? Like the insurance.
Similar concept.
Like you pay for your out-of-pocket expenses, but for the big hospital visits, the insurance kicks in and covers you.
Yeah, like we had a liver transplant, they got covered by the
By the
reinsurance.
reinsurance.
You didn't fire the person first?
Sorry?
I've seen that done once.
Fire the person.
Oh, fire them.
The litigation's cheaper than the liver transplant?
Yeah, we had to write into our plan.
Well, everybody say hello.
We were able to write into our plan